Hey guys, I'm Josh Findlay.
And I'm Ehren Laycock.
And this is the first episode of the BLD Financial Podcast. We are sitting here today with our good friend, Jack Bernstein. Jack is a real estate investor, coach. He's made his way around the block. And we are excited to have him today talk about everything real estate, his insights around helping multifamily investors purchase real estate, as well as his own personal thoughts on the market. Where are we going?
Yeah, it's a pretty good conversation. Active opinions from from individuals on both, the real estate side, from a coaching side, from the mortgage side as well too, and just some honest opinions about what's kind of working, what's not working, some of the trends that we're seeing moving forward. If you're actively in the commercial space and looking to grow, I think this would be a great opportunity to sit down and learn some stuff from the podcast.
Let's get into it. Jack, thanks for coming. This is obviously episode 1 of our new podcast. We appreciate you coming on and chatting with us. For all listeners who don't know, I mean, obviously they've spent time. If they live under a rock, they would know who you are. But why don't you explain a little bit of who you are, what you do, why you're sitting here?
Yeah, sure. Well, first of all, thank you guys for having me on. So I appreciate that. First, I'm an investor. So I've been investing since 2016, 2017 time. And I use kind of some of my investment experience to transition into being a multifamily focused realtor. And just been really kind of working at that the past couple of years and really enjoying the growth of it. Obviously, there's a lot of stuff going on in the market right now. But volatility brings opportunity, right? So, it's an exciting place to be, and looking forward to talking about it with you guys.
Yeah, no, we're really happy to have you on. It's interesting to watch the progression, where you come from. I think we connected when you were first just an investor. We've seen you obviously grow. You've done many different things. You've looked into multifamilies. You bought flips, you purchased some pre-cons. Like, your breadth of investment experience is massive for obviously your age. So really appreciate you coming on. Yeah, it's good to chat. I think the whole point of this conversation really is just like capital and debt. Ehren and I wanted to create something that was a little bit more different than just talking about real estate investing and strategy. And as a real estate investor, as somebody who navigates the markets and who advises coaches, you coach, advises your clients and your students. Let's talk a little bit about debt and how it works. I mean, we're in a really interesting time right now where debt is expensive, and we're seeing the ramifications of how that is trickling through the economy, how it's trickling through our community, and the effects of it. So, I mean, what are you seeing right now?
Yeah, so I'll talk from a client perspective, what we're seeing with people transacting in what I call like the mid-sized multifamily space, so the 5 to 50 units. I think people really looked as debt as like a single tool, maybe before we had the whole shift in the market. And they didn't realize that there's a bunch of different tools that fall with under debt, right? And different ways to structure deals and to use it and access it. And I think there's also been a lot of learning lessons of people not necessarily staying in the same groove of that. And, what I mean is people getting caught with their pants down and maybe using debt in a way that hurts them more than helps them. And I think a lot of the time what we're seeing is it's coming down to catching up to people who maybe didn't have the right advisors or people in place to give them good advice back then. We're seeing a lot of people shifting from what I would call the 3 tiers of borrowing, right? You can borrow the down payment, you can borrow the mortgage or financing for the rest of the asset, then you can borrow the construction costs. We're seeing a lot of people maybe borrowing 2 of those instead of all 3 now, which is, I think, a sign of overall deleveraging if people can. Interest rates are obviously high, so it's creating challenges for other people. And I think the one commonality that we're seeing with our clients is there's an inherent anxiety in the market around CMHC. Everybody's relying on CMHC. Essentially, it's propping up the whole Canadian real estate industry, especially on the investment side. And there seems to be no long-term stability towards, the MLI Select program or, different changes and things like that. And I think people getting caught in different refinances or maybe going to try to get 100 points in one way, and then they change that and you got to go a different route. It's just creating a bit of instability in the market. And I think working with someone like you guys is really important for a lot of people to be able to get that advisory. Whereas I think a lot of people were jumping into deals without any advisory before just because that's what everybody else was doing.
Yeah, I mean, I think people are still borrowing for the majority, like all 3. Like, I think we still see guys that are raising down payment, raising private investments for the renos and the construction, and still obviously borrowing either through VTBs, private debt, whatever it is. I think it's starting to change a little bit, but like from our perspective, I think like liquidity is still obviously the biggest issue out there, where there are guys who are definitely making moves and have their own cash, and you can even tell just sitting down and talking with them, they're more comfortable being at 85%, or hey, like maybe I want to be 65% because I want like the limited recourse. And those sometimes are like an interesting conversation when you hear someone be like, yeah, I'm okay at 65%. You're like, okay, it's not the typical like conversation you have with a lot of these mid-sized guys. So I think it's getting better, but I still think there's a lot of guys that are trying to borrow, absolutely everything. And the biggest issue there comes with, the lack of like understanding of like how financing works and the specifics around CMHC, and, too much of these like flashy coaching like advertisements for, build with 5%, buy with 5%, where, from a slightly unexperienced investor, all I got to do is go out and fundraise 5% and maybe some closing costs. And I can get into this building and I can turn it all over because MLI Select underwrites at 1.1, and, I can just make it work with my 50-year AM. And then they get in there and they realize that like, well, you have to take out every single dollar. You're forced to go 95% because you got to pay back your down payment. You got to pay back your investor capital plus, whatever sort of premiums on top. And then they get hit with the insurance premium, which no one really understands how much the insurance premium plays into the loan until they actually start seeing their cash flow every month. And that 1.1 debt service becomes like 103, 105. And, you get guys that are like, oh, I'm actually kind of like negative cash flow this month, or, I had to like replace my roof this year. I'm going to be, cash flow negative the entire year. Right. And I think until they actually start to get into the debt and see the bank account and then the actual statements on the P&L, like they don't really understand what that trade for leverage versus the cash flow really looks like until they kind of feel it.
Yeah, the issue really is like people are borrowing for today's dollar, not understanding how it's going to affect your actual investment. Like a 50-year AM, you're basically an interest-only loan. Like you're maybe maximizing cash flow, but if you're maximizing cash flow and you're like a 1.05%, you're scraping by to hold an asset for 5 or 10 years that you're paying an insurance premium on. People are definitely trading the actual investment benefits for cash today. It's kind of funny how you see these projects, these like fourplexes or 4 units plus like up down basement apartments in Calgary or Edmonton, and it's like 8 or 10 units. But really, it's just like single family homes or duplexes. Like this is the exact opposite of what CMHC allows. CMHC only allows for $1 million on residential real estate. This is a loophole around super high leverage on multiple of these units at the same time. So I think like out of necessity, obviously people are still using max leverage to be able to either access the equity in the projects to pay people back. But the big guys, are using obviously the product differently. It's and we'll get into where we think obviously the market's going to be going later on. But for the mid-sized developer investor, this insured capital is going to be the saving grace, the thing that's going to bail them out and has been bailing them out. But hopefully that's not
essentially just propping up the market, right? And the big question lies is what happens if CMHC ran out of funding, or they stopped, or they just changed the program because they had a different sentiment, different government change, whatever. So that's a big, thing that I hear people talk about. But going back to what Ehren was saying, I think there's the long-term sentiment of investing somehow got lost along the process over the last 5 years, and people need to go back to looking at purchasing properties and purchasing real estate on a more longer-term horizon. And I think that's where a lot of people got in trouble as of the past 24 months, right? They looked at the 12-month, 18-month horizon to flip their capital, and they're not looking at deals, whereas people, I would even say 10 years ago, right? Like people were buying real estate in 5, 10-year holds with the true intention a lot of the time of actually having the asset for that long. Whereas you see a lot of people now, I guess, getting coached on, get in with your capital and borrow everything, and then market flips and they're underwater on their leverage, right? So I think that's an important lesson to learn, to exactly the point you were talking about.
I think cheap money and fast, like appreciating a property definitely ruin like the long-term vision of really how you should be investing in real estate, right? When properties were appreciating 30% a month, and you could literally not fail because, you could go borrow private money. Like you go MIC money at like 3.5%, 4%, which is below where like banks are at today on like prime interest rates. You know, you could literally just go buy a house, paint it, and you make $100,000 on it in 5 days. And I had clients that were able to do that, right? I mean, you take a look at how much money was being made on wholesale fees because there was so much room on the improvement with some of these properties, right? Like guys were making, you know, $50,000, $60,000, $100,000 on some of these wholesale assignments. Like there was just so much room there. And I think people really got caught up in that, you know, that situation with money being cheap and appreciation being so quick. And you know, now today we're back into a more normal market. I mean, you take a look at where rates are at, you know, 4 or 5% isn't a horrible interest rate. It's still pretty cheap money in the grand scheme of things. And, you know, a lot of the guys now, you hear the conversation, well, real estate doesn't work anymore. And I'm like, well, real estate, yeah, is it more difficult to make some of the numbers work? Sure. But, you know, like what are we really comparing it to? You know, there's obviously guys still transacting, but it's, you know, you have to go back to having, you know, money now. Like you have to actually be injecting equity into these deals to make it work, which realistically makes sense for buying, you know, especially multifamily assets, right? Like should an apartment building be something where you can go in with, you know, zero capital down and be able to make it work? No, not really. That's not the type of asset that it is, right? And I mean, like that's not realistically how it should be working. We're back into a more normal market. And I think that's a hard thing for some of these newer mid-level investors to wrap their head around when, you know, for 2 years you could literally make money doing, you know, almost nothing, right? Like buy your property, flip it and make $100,000. Like they have to get back to that different mindset now. It has to be like that long-term, you know, hey, I'm not going to make my money right away, but in 10 years, I'm going to have my appreciation. In 20 years, I'm going to have a net worth that I can, you know, get rid of and be able to sit on.
I think they call those fundamentals back in the day. Like that's how people actually purchase real estate.
Turned into greed.
Yeah. Well, I mean, I think you look at, you know, the BRRRR is essentially psychological cancer to real estate. The fact that people could degenerately pull out 100+% of all their investment instantaneously as soon as, you know, you're able to put some lipstick on it and sell it. Like it sets such an unrealistic expectation with investors. And if, you know, we're going to talk about the mid-sized level investors, those are the ones that kind of grew over the last 3 to 5 years. So that's all they know. They just know this fast, quick money. But as you said, there's a shift happening. You know, those big guys who understand the multi-cycle generations of being able to invest and keep equity and buy a long-term hold, like that is where things are going. And I think that's why also like most people are moving into these larger projects is, you know, they're longer term assets. Where Canada's going and the return on your capital moving forward, I think is moving in that direction.
Well, I think people need to be able to understand the difference between like fundamentals of investing versus like market opportunities. Like, you know, 2020 to 2022 was an opportunity to make money. That's not like, don't mistake that for being how real estate should be. It's, you know, there was a market opportunity to be able to make that, right? And real estate and the economy go through these cycles. And, you know, that was a cycle where it was, you could make money like that. But I think a lot of people, especially obviously the newer investors who haven't experienced anything else, thought that that was just how real estate was going to be. And that's how I should be able to make money. And, oh, rates are 6% now. That's not fair. And it shouldn't be that hard to get into a home and do stuff. And I think, you know, people kind of mistake that as, you know, they think that's how it should be. And it's not, you know, that is an opportunity that will probably come again at some point because, you know, our economy is probably going to hit another point where we have to drop rates that low in the next, you know, 20 years, call it 10 years, whatever it is. But again, it's not mistaking market opportunities for, you know, how things should be investing on a more normalized basis.
Yeah, it's like the overall mindset just needs a realignment, right? Like we need to pretend the last almost 3 or 4 years didn't happen and then go back to the sentiment and kind of, you know, the way people looked at assets before. But one thing I want to ask you guys, I want to talk about too, is like what you guys see from a transitional standpoint. So you have kind of the small investor, let's say someone, the duplex, triplex, quadplex. And it seems in the past 24 months, a lot of those people that were maybe in that in, you know, late 20s, early 2020, 2021 are making the transition to being a mid-sized investor. And what we're seeing on our side from a broker is the people that are making that transition the best are people that still focus on having active income. So the days of people trying to invest, you know, without active income and not putting a focus on that, we're seeing that it's almost impossible for them to pull off deals. And I think it's one of those things, the long-term mindset needs to be as well. You got to have a job, you got to have income. And it doesn't matter what size investor you are, you know, unless you're at an institutional level, you need to put a hard emphasis on actually making money too.
Absolutely. Yeah. Absolutely. I think, you know, I can't tell you how many people had like little little retirement parties over the last 2-3 years, but but that's not the reality of purchasing these assets. Borrower covenant is important. I can't tell you how many times people are like, oh, well, debt services. Well, no, the building qualifies for the debt. The approval is based off of you as a human being, your net worth, your experience, your liquidity, your ability to be able to generate revenue and have reserves. A lot of people lost that in translation along the way when they decided or wanted to get into these multifamily buildings.
Well, they made $100,000 on a flip one time, so it was enough to quit their job and get into real estate full time.
Yeah, it was having real income and real liquidity is probably one of the most important things, other than the actual debt servicing of the property itself. As capital markets tighten up or as they loosen up, and then defaults become more rampant and the lenders become a little bit more tight with their capital and their underwriting, you can definitely see that, where is your access to cash? Do you have equity and access to equity in these properties? When you're looking to take on a 12-unit project and you have a boiler go, or you have a roof that needs to be done, do you have a few $100,000s that you can access? People soon forget that the 12 families that are living there are your responsibility now. You can't just BRRRR it, have no net worth, have no capital, have no ability to be able to make money, and the lenders should be okay with it just because CMHC said that it debt serviced. 100%. I think a stronger borrower is needed in this market. Lenders are no longer relying on strong assets in a single place. They're looking at your portfolio of debt service more closely. Are you underwater on anything? A lot more questions are coming to the actual viability of the borrowers themselves.
There's a lot of credit unions that were switching to asset DCSR, but also taking a look at a personal TDSR, like a total debt service ratio. Like your building had to qualify, but not that your personal income wasn't always a factor, but they were underwriting it more stringently on that factor. And if you couldn't service your debt at a 1.2 on the personal side, even the building was qualifying at a 1.2, they weren't giving you the full loan of value. Because again, there is a concern. And going back to what you said, especially on these multifamily buildings, and especially for mid-sized investors, when you're underwriting at a 1.1 debt service, even on a sixplex, if we focus on newer investors, 6 to 8 units, that's $12,000 a year, maybe tops. That's your income on this building. On some of these smaller 6 to 8 unit stuff, sometimes even less, depending on the location of it or whatever. If you're buying up north Sudbury, maybe you're $7,000 or $8,000 on a 5 or 6 unit building, 7, 8 unit building. That's not a lot of cash flow. If you have a boiler system, if you have a roof, you have windows, you have something that you have to replace,
sure.
That's going to eat that cash flow, maybe even for 2 years, right? So that's more focusing on the investor, or on the newer investor who's kind of transitioning into there for the first time. And in today's market where CMHC is really the only option, they really need to be aware of how little room there is. Now, obviously, if you're a larger investor and you got the more portfolio size, you can, you got 100 units, 200 units, whatever it is, 300 units plus, you're able to offset the cash flow on that. You're probably not taking as high of a leverage anyways, especially if you're in Toronto, you're not 95% loan to value. You're 65, maybe 70%, even with CMHC.
If you could, they would though. Don't lie.
They for sure. But I think it's for the new and the mid-level guys. I think having that job. We're seeing lots of investors going back to jobs again, right? You have to be able to have that money coming in. You have to have. You take a look at how expensive it is or how difficult it is to make projects work right now when you have to pay back your down payment and your renovation construction costs, right? There's projects out there that people could be able to close on, but they don't have the capital to do it. They got to go fundraise it. Then they got to worry about paying them back. They have the monthly interest rate on top of that. And the conversations that we have, you take a look at, your bridge into a repositioning, you're right now 8.5%, but conversation then, 9.25%, 9.5%. Conversation was, that's too expensive. I got to pay my monthly payment on this, and I got to, I got to pay this guy, I got to pay that guy, whatever it is. You have to just be able to have these secondary sources of cash flow coming in until you're truly in a position where you can, take a step away from working, right? And be able to.
You hit the nail on the head with that, because I think what newer investors don't realize, even people in small multifamily, is it's much different than residential. Residential can hurt you, but it usually doesn't knock you out. But larger multifamily, if it goes wrong, it will bankrupt you. we've seen a lot of people where it's taken them down, and it's taken them down hard. And I think that's maybe something that's not emphasized to a lot of people that are sizing up, that you can financially destroy yourself if you don't put the right stops in place, don't work with the right team, and essentially just don't have cash reserves, right?
Well, you need to really just understand the cost of actually doing it. You got so many people, and again, CMHC is a buzzword, but you don't acquire with CMHC on a pre-existing building. So, understanding the cost of doing this, your minimum on a bridge loan, $250,000 for every $1 million. If you're in a decent area, you're going to have a $2 million building, 10 units, $200,000 a unit. You're $500,000 in the buy. You got a broker fee, you got a lender fee, you got your land transfer tax, you got, let's say, half
6 months of interest reserve,
6 months of IR up front. You realistically, you want to turn over half the units. Let's say that's 5. You got $30,000 a unit, interior, exteriors. You're probably $800,000, $900,000 in liquidity to take on like a $2 million project.
Jesus, 15, 20 grand now.
Yeah, the amount of capital the amount of capital needed to do it is astronomical. So, which is kind of why we're seeing a shift to purpose-built construction at the moment, because I think what's happened is the mid-sized investors who played in the space, unless you truly spend a ton of capital in bringing that building to where it needs to be for the remaining economic life to be 55 years, and your capital expenditure to be pushed out 20 years, the capital calls alone on these projects as you continue to own them are just so large that people are understanding that why risk all that cash when I could build new, when I don't have to deal with the capital calls on something fundamentally breaking internally in my building over the first few years of owning it, or the tenant requirements. I can now have market rent at all times because it's a new build building. There was a fad. People made a lot of money because the legacy rents versus the market rents increased so fast. But we're seeing a lot of people just move into that new construction space. But no, go ahead.
No, I was just going to say, yeah, it makes sense, right? It's you gotta adapt with the times. What worked 3 years ago doesn't necessarily work now, and maybe what works now might not work in 3 years, most likely. I think the issue people have in mid-sized investors that people need to put more focus on is underwriting more conservatively. And something Mike Rock always told me that they manage in their fund is looking at tenant profile. A lot of people look at a rent roll and they say, okay, well, there's 10 rents that are at 50% of market value or whatever, we're going to flip those. But the reality is those are the ones that are almost impossible to cash for keys, right? It's more like the mid rents that are maybe 20, 30, 40% less than what market is that you're actually probably going to have a chance to turn. But the people who are paying 60, 70% less than market, they're going to fight tooth and nail to get out, or you're going to end up paying some absorbent amount that then throws your underwriting out. And I think a lot of people make that mistaken calculation, then they get into a deal and they go, you know what? We actually need a lot more capital than we thought.
People don't understand the intrinsic cost of risk is the problem. On paper, running numbers saying 50% turnover increase from your EGI is viable, but in reality, as you said, it's not always viable to be able to do that in such a short period of time when you have high cost of bridge debt and you have to turn over those tenants, or you don't be a degenerate and you put down the down payment needed to be able to not be underwater on your deal and you wait it out. But again, that's not the mid-level investor in Canada right now. Those aren't the guys who are trying to get to the point where they can continue to buy buildings. Those are the guys who who have lots of capital. And they are out there. There's lots of guys out there who do put the down payment down and just slow wait it out and turn over or increase the efficiencies of the building. But it's challenging for sure.
I think there's also a misunderstood safety of underwriting where, you can get into a bridge loan based on your underwriting of tenant turnover. And it's well, they gave me the loan, it's going to work, it's going to exit. But, it's not our job to ensure that you can actually execute on that, right? Even for the lenders, if you go to Equitable, you can give them a 50% turnover. They're okay, let's target 15% a year or maybe 20%. They want to keep it on a more reasonable level because they know it's, the chance of you going in and clearing out an entire building and 100%, you're a 1% chance. You're really going to get in and turn over 100% of the building. Maybe a 10% chance to even get half the building done in a first year, right? So again, I think, the execution of the project, you still have to be comfortable in the actual execution as an investor, right? If you're banking your entire project on a 50% turnover in 12 months or 18 months, whatever it is, and you don't pull through, like we can underwrite it all you want, and you can look at the numbers and you can see the debt servicing and everything like that. And on paper, the project might actually work, but it doesn't provide an actual guarantee that you're going to get the project done. You might run into a couple, hard-headed guys that are legacy tenants, and they've already talked to their, paralegal because, one of their buddies got kicked out of an apartment, and, they know what's going on, and you might not be able to get them out, right? So I think there's also the underwriting has to go a few ways, and it can be dangerous on both sides, right? You can almost over-insure, or you can, sometimes you just mis-underwrite in the wrong way. Maybe you miss a deal because you're not looking at it properly, or maybe you over-exaggerate a deal. It's, there's so much that goes into the understanding, and also just working with people that actually understand how to underwrite as well too, and not just relying on the realtor data sheets, because there's a lot of realtors out there that don't know how to put together good data sheets, especially like multifamily stuff. Zero vacancy because the building's tenanted, property management, where it's self-managed, so there's no property management, right? It's just understanding. Also, CMHC has its own expenses. They take a look at the value a little bit differently. They're more conservative on a cost per door for the loan size. There's just so many different avenues that you have to be completely aware of how the numbers work.
I 100%. And I think people who want to get into multifamily, if they're not an existing investor, or if they're a residential investor sizing up, like a fundamental skill set that they need to know is how to underwrite. Relying on your broker or the financing underwriting doesn't necessarily mean that's what the actual project is, right? And we get some clients that come to us sometimes and we say, what's the total return that you guys are targeting on your investments? And they say, well, we don't know. We just know the financing, the numbers, and the DSR hit. And there's not as much benchmarks with that kind of stuff. But when you look a little bit higher, of people that are maybe on their second and third building that do have those fundamentals dialed, a lot of them have similar traits, right? They work on one building at a time. They typically stabilize that asset. They're not over leveraged. They move on to it. They're usually what I would call like a legacy investor. They've been in the game for a long time, and they're in it because they move at a steady pace, not a very quick pace. I would say maybe 5% of people that move really quick get to move quick safely, and the other 95% of people come into some sort of trouble, right? And we all know many people that have come up within the past couple months, year, whatever, and it's hard, right? Because being a newer investor and working with clients, sometimes they see these people and they say, what am I doing wrong? How are they moving so quick? I must be doing something wrong, right? And the reality is a lot of those people are moving quick, but they're moving quick in unsafe ways, and they're not in the game for a long time. Yeah. And I know there's some clients that we share together, you work on the financing with, and they're just rock solid investors, right? They move slowly, they move very precise, they know their deals very well, and they kind of pick a vertical in multifamily that they like, and they just know what they know, and they follow that, and they don't deviate from it, right? Unless there's an extreme circumstance. But those people last, and that's the key, right? It's lasting for a long time. It's not just buying as much as fast as you can necessarily.
I think we talk about investors not having a full understanding of what their goals are. And this even goes into real estate, just residential real estate. Should I refi? Well, what are you looking for? Are you looking for a cash flow per month? Are you looking for an equity takeout? Or are you buying because okay, maybe your negative cash flow, $200 a month, but are you okay to essentially buy your equity over the next 10 years for $200 a month? How are you looking at it? And there's a lot of investors that go, well, I don't really know. I just want to know if I can finance my property. And on the multifamily side, I think there's a difference between can I buy this, as in can the debt servicing work, versus should I actually buy this? Just because you reach a 1.2 debt service, are you making your cash on cash return? You're hitting your ROI? The other metrics, not everyone really has them. You do need to be able to focus on your goals, and just because you can buy an apartment building at a 1.1 debt service with MLI Select, does it actually mean you should buy it? Does it fit your portfolio? Is it going to work for what you're looking to do? And I think there's sometimes a misconception of well, the building works, so I can buy it, and I should buy it because it debt services, but it may not be what you're actually looking for.
Yeah, I guess it comes back to I always say, look at what the big guys are doing, right? The smartest people in the room are smartest people in the industry. A lot of people, I feel like maybe they move because they think it's the cool thing to do, or they're buying stuff because they just want to have a building or whatever, but maybe it's not the right time. It's not the right deal. And, I don't know. I think for people jumping into it, there's always opportunity in every market, but there's probably more opportunity coming down the pipeline in the next 12 to 18 months than there currently is maybe right now. And, people who want to get in don't feel like it's too late, right? There's still opportunity, but just be more careful now. There's got to be more safety, safe blocks in your process.
Absolutely. I think that there's also this issue with people who, once you're in the game, you have a flywheel that starts turning, right? Like you buy, you refinance. Now all the refinance money that you have is a burning cost of capital, right? So you're continuing to having to deploy capital. Now we talked about this before you got on air, and the guys who borrowed the money or who have investor capital still need to deploy in this market. So it's interesting to watch these guys as well have to actually find deals that are going to make them a higher return than obviously what the debt cost they're paying as well. So it's we are seeing people still transact in the market. It's interesting, as you said, watch the big guys. The big guys aren't transacting in the small space anymore. They're getting rid of all the small stuff, and they're making room for all the retail investors who can't afford residential real estate anymore. They're all buying up. The guys who bought 4 plexes are buying 6, 7, 8 plexes, and so on and so forth. So it's opportunity in the market still, but it's interesting to see where things are going.
Yeah, I'd love to know, do like a little deep dive on Instagram and see how many profiles still have like a door count. I mean,
that was my favorite.
That was huge over the 2 years where real estate was hot, and the door count was plastered everywhere. But
my favorite's the LP investor, right? Someone who's putting a 40 unit deal together, and someone comes in with a $10,000 LP investment on it, but adds 40 doors to their Instagram or whatever. Yeah. But you know what? Honestly, like a lot's changed. A lot of people have been weeded out, and a lot of people don't talk about it. But if you went and you probably looked at all the podcasts and the guests between all the big ones from 2020 to 2022, probably half the guests now aren't in real estate or doing stuff or they're back to their jobs and whatever, right? So yeah, there's pain out there, but there's also opportunity.
Massive amounts of opportunity. Yeah.
Well, and that's the difference between underwriting a REIT and taking a look at like a REIT's lending consensus and what they're taking a look at and what their white paper is versus like a mid-sized investor. Like the reason why REITs aren't transacting or haven't been transacting over the last few years versus the mid-sized market who has been maintaining probably the majority of the volume is like the risk level and the appetite is different, right? Like a REIT's not going to go out there and squeeze out small margins when they can sit and wait, and the majority of their lending is done off balance sheeting. And if they're out there taking up these small little margins, all you're doing is impacting the balance sheet. Whereas from like a mid-sized investor, your opportunity to become a big size investor is, essentially taking a look at, like you're cap rating the risk right now, right? Like, to be able to take up these smaller margin properties and build those victories and kind of hold on to them. Like that's how they are going to, like those are the building blocks to become a larger retail type investment firm or just a larger investor in general. You have to take that opportunity when some of the bigger guys aren't.
And they have different obligations, right? We were talking off screen about a REIT that I was just speaking to about an hour ago, and they have about 2,000 units in a private portfolio that they have, and then they have a public arm of it. And basically, the private arm of their fund is not buying. They have a whole different strategy. And then the public arm that has to deploy investor capital, they're falling in that exact hole, right? And it creates a false narrative where, they're still buying whatever. They're only buying because they have to buy and they have to deploy capital and they have a fiduciary responsibility, to work on getting a better return from their investors. But having money just sitting in an account, doesn't work for a REIT, right? So I think if people understood a little bit more the nuances of how that kind of stuff works, it would shine a different light on it.
That's like the education and like the financial literacy is like, that is the gap though, right? Like that is the misunderstanding.
For
it's
sure.
the understanding of the products. It's the understanding of why certain guys are buying and why certain individuals are not. And, why is it still an okay environment to be investing at, even though rates aren't 1.5% anymore? Like that's why we're doing like these podcasts as well too, right? And that's why we've done our educational stuff. And that's why you get into the coaching and the real estate side is like, there is that huge opportunity for the knowledge and the education to be able to help teach people and help them understand like what's going on. And the better that you can do that, if you're also in some sort of profession that links to real estate, the better you're going to do in that profession. And, if you can teach a client to invest properly into properties and how them actually build a portfolio that's going to debt service and cash flow and appreciate over time, like you're building a lifelong partner in that business, a lifelong client, versus the guys that are out there just sticking people into quick money grabs, private lending, stuff like that. Like those are one-time, dollars into the bank account versus actually creating a stable client that's going to have success and increase like your success from the professional side as well.
Yeah, exactly. And it comes into like relationship. It really is a relationship business, right? So if you give that, that student or the client or whatever that experience and, you look out for their best interest on it, like that relationship's typically going to, skyrocket to something else. Most investors, when you work with them, they have aspirations of buying multiple properties or growing and whatever. It's not like the residential side where someone transacts a single family home every 10 years, right? So I think, people finding who those relationships are and actually making an effort to invest in those is very important. And I think a piece of advice for younger investors is, try to find formal or informal mentorship and make an effort to educate yourself throughout that process, because a lot of people skip that step over the past couple of years.
And that's kind of like the do or die situation. Like you have a mentor who has gone through the cycles, who has seen the tops and the bottoms and understands when to buy, how to buy. And usually when people are screaming buy, you probably shouldn't be buying. It's what does Warren Buffett say? Buy when there's blood in the streets. I think like this is now the time when you're starting to see major people or major funds start to deploy capital to clean up the streets, I guess. We were talking to, I guess I won't say his name, but we were talking to somebody last night. Ehren and I were having dinner with them, and they're putting together a few $100 million in a fund to be able to purchase distressed condo sales from developers downtown Toronto.
Wow.
That can't close. They're going to come in at 65 cents on the dollar. You had something selling at $1,900 a square foot. They're looking to not transact at anything under or anything above $1,000 a square foot. They're going to be able to get sometimes 50% off on these condos. But these guys, again, are sophisticated. They have the tools and abilities and stats and understanding and capital to take a calculated risk in this market. And there are, I'm assuming, tons of people like that who are looking to find that opportunity.
It makes sense.
Crazy.
The market of condos is going to come flooding back at some point. We're already on a shortage of units. Like empty vacant units can't sit empty and vacant forever. Like they're going to be sold off at some point down the road. And again, it's a larger scale, but take a look at the power of being liquid. Yes, they're probably leveraging like bank lines and stuff like that, but you don't get to be able to leverage that stuff if you aren't liquid or you have a strong enough asset anyways. But the opportunities, they're there. That's a huge opportunity if you have the ability to execute on that.
Yeah, absolutely. Touching on, previously we were talking about the transition from retail investors, what we're seeing now, but where do you think things are going? You deal with all different types of investors. You deal with institutional investors on the multifamily side, and you also deal with your students, some of them just starting out. Where do you think things are going?
Yeah, so a couple different things. It's interesting. So we have a unique approach where we work with a lot of institutional asset managers that are doing exactly what you said. So they bring us buildings kind of the 5 to 50 unit, more so kind of the 20 to 50 unit that they're divesting of, and then we try to place that with other people. So we get a perspective of trying to bring a mid-sized investor into a deal that's coming from a large institutional investor. So we see both sides of it. Speaking to a lot of people, it sounds like things are going to get worse before they get better. Rates aren't going to drop quick enough to save, the blood in the streets. And I was talking to, what I would consider like an ultra high net worth individual last night. And his consensus of the market is that, instead of the 12 months that a lot of people are predicting of, getting worse before it gets better, he's thinking it's more of a 24, 36-month horizon of opportunity being there. The younger investors that we have and people sizing up maybe like a 6-plex, 7-plex, whatever, there's still lots of opportunity in there. And I would say the smaller investor, 10 units and under, there's more distress in that space. Whereas when you have a 10 unit to a 50 unit or potentially more, it's usually owned by some high net worth individual or someone who can maybe weather a storm a bit better than a smaller investor. So the smaller the unit count or dollar value, typically now we're seeing more distressed. Whereas you might see 30-40% of deals there are distressed from sellers. And as the unit count goes up to maybe 30, 40, 50, it's maybe 10 or 20%. The 80% of people are selling and fishing in the market, but they don't really need to sell. They might want to sell, but a lot of these guys have deep pockets, right? So I think there's opportunity on both sides. It's a little bit easier to find more creative and better distressed deals on the smaller scale. As the units go up there, I would say it's harder to find better deals, but it's easier to get more attractive financing and VTBs and things like that from the sellers because they're in better financial positions.
Yeah, I think the ones who have the means to be able to transact at lower rates but at distressed sale prices are going to be the ones who are going to make it like bandits. Kind of unfortunately like how it always works. The ones who have the money in downturns make all the money. I think you hit it right in the head with the timeline it's going to take to be able to bring things back around. The policy rate decisions we're seeing now, 18 months later from the start of the policy increases, the maximum amount of pain because there's been enough time now to cycle through the economy. I think it's going to obviously be on the flip end as well. As we lower rates, it's going to take 18 months after the final rate cut to be able to really have that alleviation and run through the economy. So I don't think we're probably right in the middle of it, right? From the start to the end, we're probably smack dab in the middle. Where things are going to go, opportunities out there. I think that's kind of the word of the day. Like the people who surround themselves with the right statistics, understanding the right capital, the right type of assets to be able to buy. They're going to be the ones who are going to make money in this specific market.
Yeah, I mean, like interest rates are only coming down because inflation is coming down because unemployment is like going up, right? Like going to like blood on the streets. Like
it's hard. You're investing on Canada to fail, essentially.
Well, I mean, it's people are cheering for like interest rates coming down, but it's like you're almost kind of cheering for unemployment at the same time, right? Like that is a huge factor playing into inflation, right? So I mean, it just it does go to show kind of like the lack of, I think, understanding from like a general pop type perspective. It's just they just look at it as like interest rates are coming down, but don't really understand like what's going on in the back end and like what that really means for the economy as a whole, right? I mean, like you take a look at public sector versus like private sector jobs, how many small businesses have been lost over the last like 5 years, since like COVID, unemployment screaming. Like it's like overall, like, yeah, rates are coming down, but like, from a whole perspective, like it's a bit of a mess.
It's tough out there. And I think a lot of people don't understand the macroeconomics and how it works with that, right? Like you need a large piece of the population to essentially be unemployed to get rates to come down, which is almost like betting against the population. And the reality is it's probably lower income people, lower income jobs, and people that are already hurt the most that are just going to get hurt more. But going back to the environment of, the 24, 36 months or what's going to happen, there's going to be an interesting time, kind of like what happened in 2008, where we're going to get a shift in a parallel where there's going to be a lagging effect from interest rates on purchase prices, and rates are going to reduce, and you're basically going to probably have a 6 to 8 month window where you're going to be able to buy cheap assets with cheap with cheap debt. And I think people who buy deals in there will probably get some life-changing deals that they might have not thought they'd ever seen since 2008.
We're close. I think you're buying today's price, tomorrow's rate. If you have a project right now, especially a multifamily project, and you acquire this project with a timeline of 12 months to complete that project, and you're able to get and negotiate vacancy on possession, you're able to get a good cost per door on it. I think we're in that time right now where if you can find someone who is distressed or find a seller who is more apt to being able to give you that VTB at a decent rate or vacancy on possession, you're playing next year's rate. And realistically, if you take a look at where we're priced at right now, we're 25 basis points for every single policy rate decision moving forward over the next 12 months. You're, I believe, 180 basis points priced in as a decrease. So, obviously it's a gamble and you're rolling dice on the board.
Sure.
But barring no World War III or black swan events, but there are a handful of investors who are placing those bets right now. Especially if you're going to go buy in 12 months, you're not catching that low rate at the end of your project. You're catching kind of at the start, which you're probably not going to get the best buy price.
Well, I think you're seeing that on like infill development. I mean, like especially in the GTA with right of use coming in. Like there's guys out there that have money that are just buying properties because they know, once this change comes in for right of use, like that property's going to be like the value is going to skyrocket. And, as the rates come down, money becomes more liquid. Guys start coming in because it makes more sense on their own numbers. That's, it's that competition, right? It's the first time home buyer issue, right? Where everyone's waiting for the rates to come down. I mean, you have investors that are doing the same thing, right? They're all waiting for the rates to come down. But as they do, and as more people start to buy these pieces of land or what the building's on them, and the realtors start to catch on or the sellers start to catch on as to what they're doing, like, oh, you're buying my single family home for, $1.2 million and it's gonna be worth $4 million in 5 years because of a 6-story like right of use. Like, well, I'm gonna sell my property. Like, you got to catch it before that trend kind of starts to hit on. It's almost like when people were selling apartment buildings back in like 2021 and they were pricing in like 30, 40 extra percent because, oh, hey, look at the repositioning value allowance here. And you're going to be able to flip this for this much. So I want to make an extra $200,000, $300,000 because I know what you're going to do with it and how much money you're going to make on the back end, right? I think once the volume starts to hit with people buying, especially in the GTA, but, just anywhere now that you can build 4 units at least, I think we're going to see something similar there, and they're going to start to catch on, and prices are going to go up. And once people start buying in general, prices are going to start to go back up. So.
It's always an information race. Who can get there first and do what they need to do with the information before the average person figures it out?
Yeah, and that's why, I think the biggest thing is action takers, right? People who are willing to take the action and get past the mental boundary of doing the opposite of what the rest of the market's doing. Those are almost always the ones, who get paid the most, right? And time and time again, it's usually a lot of the same guys. But the cool thing I would say about the market is there's a lot of younger, newer guys trying to punch their way up and get in their first deal, and or maybe mid stabilization or getting to that to be able to see some of those opportunities. So it's nice to see at least that there is like another generation coming of that, because people always talk about it's too expensive, it's unaffordable, the opportunity came and went, can't do it, but. If you think that, you're just not in the race, and there's other people racing against you.
I say this even with like home buyers, like, yeah, it's difficult, and no one's saying it's not difficult to get into your first property, but we've seen investors that are making $70,000 by themselves that have 3 or 4 properties. The risk is higher. Definitely, for sure, you're taking on private debt. Maybe you're borrowing money from a family or a friend or whatever to be able to get it done. But you got families making 125, 150 household income and struggling to buy a property. You got an investor out there, with 4 properties and $70,000 of income, right? It is doable. You have to step outside your comfort level for sure. You're not just gonna be able to walk into a neighborhood and buy a nice, cozy, like detached bungalow and have your house, right? But again, like the opportunity is there and the products are there to be able to get it done. It's just you have to be able to take a risk, or you have to be comfortable taking a risk now, to be able to make it work. But opportunity is definitely there.
Yeah, absolutely. I think that how people go about investing and purchasing real estate in Canada will fundamentally change forever. What was once a duplex conversion, which was easy, is now pooling your capital or finding different creative resources. And then we always loop back to this, which is like the information people you surround yourself with, their coaches, your realtors, your brokers, the people who are moving the needle and sharing the information. Like, this is an information age where the more you know on how to use capital properly, how to raise capital if you're going to raise capital, the type of debt you need to use and how you can go about transitioning it, that is going to be the most important asset that an investor has moving forward. You can't just throw it at a wall anymore and hope it sticks, because Scotiabank isn't going to give you the loan anymore to actually be able to scale at a level that makes sense. Asset prices are too high. Incomes aren't keeping up to those asset prices. You're not going to be able to service the debt the same way you were. Debt washing isn't going to work anymore when all the debt is significantly higher than what half the income is in the property. So the best tool you could possibly have moving forward as an investor is going to be the information that you and I or Jack can give them to be able to continue to scale.
Well, building on that, a piece of information that I've heard some people talk about, but not a lot, and it's a reality of the market, but rents are coming down in most cities in Ontario, which are obviously impacting, returns on larger multifamily and, net operating income and so forth. But even on the residential side, like we're seeing in different areas, 2 bedrooms that would have rented for 2,200, now they're coming in at 1950. So for someone who's maybe got a duplex or a triplex to get a $250 a month, chunk shaved off on tenant churn, especially maybe having to do some light renovations and stuff like that, that's something people need to be wary of, right? So not everything always goes up. And I think people need to pay more attention to that kind of stuff, because I speak to people all the time and they're underwriting on what their rents are. And they almost have this ideology that they forecast future rent in their underwriting, when the reality is we're shaving off 5 or 10% right now on tenant churns in most major cities, and Toronto's really getting hit hard with it. But I mean, Kitchener, Waterloo, Brantford, St. Catharines, a lot of the West End, even on the East End, Ajax, Bowmanville, all those kind of places.
Why do you think that is? You think that it's an affordability issue, that people are just living, multi-families are living in the same single unit, and it's just like a fact that life is too expensive and people need to shave off some costs? Or
I honestly just think it just capped out. Like, people just do not have any more money to just put on their living expenses. People are so stretched and taxed to death, and wages just never caught up to inflation. And I think the lagging effect of that on so-called like the average person is really affecting people. And I think the opportunity and the amount of people that are willing to move because of the inherent expenses with it are what's driving down rent. So is it a long-term issue? Probably not. But if you think about it, it's actually really weird. We have record immigration. We have more people ever in the country. Supply hasn't increased very much over the past couple of years, yet rents are trending down. So it's like the economic data is pointing to everything that it should go up, but the reality is it isn't. And I think it's just exactly that. People just capped out on what they can afford.
Yeah, it's going to be interesting to see how that affects all these purpose-built rentals that are going up. Do you move to higher-end micro condos? Where now just it's okay, or like that the new standard is you live in a 300 square foot box and you can afford it because it's $1,800 now, but it has nicer finishes, and that's kind of where just things go moving forward. Obviously, if we have a prolonged market where we have softening in rents, I'm assuming that's where things are going to go.
Well, I mean, do you even need to be careful, like when are you pricing out your pro forma versus like when are you going to be renting? Like, I had a client, they were talking to the realtor, they were pricing things out, like summer, like peak rental market, and started to lease up, like December, January. And they were like, we're just not getting, like, the market activity just wasn't there. And they were losing, $150, $200 on some of the units. And it's just like understanding, like, when are you looking at your rental rate? So when are you actually going to be leasing up? Are you leasing in an attractive time when you're going to be able to get it, get a tenant who's going to want to pay, right after the holidays? I'm sure people are trying to save as much money as they possibly can to the new year. So it's just like, even little things like that, like just understanding the cycles of when people are looking to rent and when rent's going to be highest, when are you running your numbers versus when are you actually be leasing up? Like, even that can be a big difference in today's market. $100 a unit loss on rent, that's a big difference on your valuations, big difference on your cash flow.
Plus, time to fill vacancies is probably doubled as well, that people don't talk about. We're seeing on average, it's usually 60 days to sometimes in some markets 90 days to fill vacancies with qualified tenants. So when people are used to getting exactly that, forecasting at a premium at maybe the best time of year in the summer to rent, and then they're also not factoring that, it's a recipe for disaster. That could be a 20% miss on what their actual income is, right? They're incurring more expenses by having vacancies longer. It's getting harder to find qualified tenants, and then they're just burning capital essentially.
Yeah, and then you just you take whatever someone comes in $300 under, $200 under, you're like, I'd rather have this than nothing, and then all of a sudden you're $200 loss per month on rent.
I guess the pro with that of all this is that the LTV timelines are coming down, so there's got to be some sort of positive in it. But I know that's a whole other mess in itself. I don't even want to get into that.
Yeah, that's a rabbit hole we can go down for a bit.
It's almost like it's a 6-month like podcast episode if you wanted to really weight the timelines and go through it all.
Let's see where it goes. Yeah, I mean, needless to say, I think that the market's an interesting place. Borrowing capital right now, if you know how to do it properly, you can catch a market. As you were saying, you can buy today's price, get tomorrow's rate. If you're planning out projects, make sure you're looking at the macroeconomic view of it all. Talk to your brokers. Take a look at like historical trends. You can take a look at past recessions. What happens with rates when recessions hit, and what happens to asset values when recessions hit? You can take a look at certain types of asset classes. Does multifamily hold up? Industrial? There's lots of different opportunities out there, and we're going to continue the conversation. I think that learning how to use capital in different markets will allow you to take on opportunities that weren't necessarily available to you at these hotter markets. So, all in all, man, appreciate you reaching out. Appreciate you coming on here today. This is the first one that we've done. It's awesome to see your growth, to see what you're doing. If people want to get in touch with you, how do they do that?
Yeah, thanks for having me on. Best place they follow me is Bernstone Capital on Instagram, or check out my website, www.bernstonecapital.com. Feel free to reach out. Happy to have a call with anybody. So once again, thank you guys for having me on. I really appreciate it. Yeah,
our pleasure. Guys, if you guys want to tune in next time, we are having one of our lenders come on. They're from First Source Capital. We're going to talk about construction financing, funding the missing middle. Stay tuned. Check out next episode.